Hello, everyone, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, M&A Market Update and Transaction Considerations. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I would like to turn the floor over to Michael to start us off here. Michael?
Yeah, thanks, Amy. Good day, everyone, and thank you for joining us on this webcast. As Amy noted, I'm a Managing Director in the Transaction Advisory Services practice at Moss Adams, which is part of our Deal Advisory Services group. At Moss Adams, we provide services in several key deal-related areas, including due diligence, M&A tax, post-merger integration, and restructuring. We also provide valuation services within the Deal Advisory Services group. My key area of focus is on the financial due diligence side, where we assist private equity and strategic buyers and sellers as they navigate through their transactions. Today's focus is on transaction considerations in the construction, design and engineering industry, as well as building products and materials companies. And today I'm happy to have joining me James Rothenberger from Meridian Capital. I'll turn it over to you, James.
Thanks, Michael. Hello, everybody. James Rothenberger here from Meridian Capital. I lead our firm's engineering, construction, and building products practice group, and we help businesses sell their business, buy another business, raise capital. We also help them prepare for transactions. Our typical client is about $20 to $500 million in enterprise value. And again, I lead our group that's exclusively focused on engineering, construction, and building products companies. And so what we wanted to cover with y'all here today was certainly what's driving such robust M&A market activity. Who are these folks? Valuations, and some key considerations to think about if you're considering selling a business, buying a business, or raising capital. And it looks like, Amy, we have our first polling question here.
All right, thank you, James. So our first polling question is to get a feel for the audience that we have today. So what industry are you from? A, construction, B, architecture, C, engineering, D, building products, E, building materials, or F, other. And we will give you a few moments to respond. Please click the button next to the answer you choose and hit submit. And if you have problems seeing the submit button, you may need to enlarge your slide area to see it. And it looks like most have responded. So here are the results.
Good. So we've got 27% from construction, a smattering of architecture, engineering, building products, and building materials. Curious about how others would describe themselves, but we'll certainly try to address the component and input providers into the built environment, which we will hope and will encapsulate many folks that categorize themselves as others. So to kick it off here, top M&A activity drivers for construction, design, engineering, and building products and materials companies. Quite frankly, it's just an exceptionally robust environment right now from an M&A perspective, with record high volumes and valuation multiples across just a number of sectors. And there's several reasons for this. First, robust economic demand in many segments post-COVID restrictions. While there's really robust demand in a number of segments, there's a couple that are just certainly worth highlighting. As you may expect, cold storage and the related cold supply chain, residential HVAC, fire and life safety. Residential HVAC and fire and life safety have just about the maximum enterprise value multiples that those industries have seen in their long history. Just a tremendous buyer universe there with a willingness to pay pretty fancy prices. Telecom, utilities, and infrastructure, and any construction services servicing the advanced technology, life sciences, and data center operators. This is just to name a few that have very robust economic demand. All of these end markets have customers that have weathered the COVID storm very well and have capital to deploy into new building projects. Second, quite simply, delayed transactions from 2020 pushed into 2021. I have a chart on that later on here that you'll see. Just a number, uncertainty causes delays in transaction activity, and obviously in Q2 and Q3 there's quite a bit of uncertainty last year, and so those deals are now pushing into 2021 and resurfacing. Three, potential for increased state and federal income and capital gains taxes, depending on where you live. You know, the federal piece impacts all of us. I think there's maybe less and less confidence in anything there is going to materialize in 2021. That is material. And then again, depending on where you live from a state perspective, there's various proposals out there, of which obviously Washington has a proposal of a capital gains tax that is significant and material. And then lastly, record amounts of strategic and private equity capital seeking private investments. You've got strategic companies out there with very large balance sheets, a lot of cash, and then you've got private equity capital, a lot of money, and that cash has to find a home. And a lot of companies are finding a home in privately held, family-run, entrepreneur-led businesses. And these four are not the only reasons for robust M&A activity, but certainly we're seeing these four come up on a daily basis when we talk with our clients. So Amy, I think we're at our second polling question here. You want to lead this one?
Sure. So our second question is, are you considering making a business transition? A, yes, B, no, C, I don't know, or D, not applicable. And we'll leave this up here for a few moments. And as a reminder to our attendees, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions that we put up. All right, here are the results.
Pretty balanced, mixed year, not terribly surprising. You know, folks don't wake up every day deciding they want to do a transaction. It's usually in the back of their mind for years. So again, we'll talk about who's out there buying who, what do those folks look like here in the next few slides. So when you look at the most active private equity and strategic buyer profiles out there in the market, and a strategic buyer, just by definition, a strategic buyer is going to be somebody that operates in and around your industry. And a private equity buyer is going to be a financial buyer that's raised a fund of cash that they want to go deploy and invest in small and medium-sized family and entrepreneur-led businesses. And so we listed a smattering here of the most active in each of the 4 verticals that we're talking about today. STO Building Group, DPR, Knife River, all very successful commercial builders and civil builders and building materials and aggregates providers, very acquisitive. And Peninsula Pacific, New Mountain, and 10X have shown a willingness to invest in contractors and construction services providers, which is a little bit of a newer trend in that segment. Traditionally, private equity has avoided that segment. Design and engineering, certainly, you know, Tetra Tech has acquired 8 businesses in the last 7 quarters. Just a torrid pace there. AECom has been divesting the com part of their business and acquiring the A and the E part of their business. So lots of transaction activity coming out of AECom. Level, Minnick, Oaktree, and Bluepoint all have great experience investing in professional services organizations that focus on design and engineering. Building products, boy, what a consolidation on the building product supply side with folks like USLBM. I'll go into more of that later here. But NSI, a major provider of HVAC and related components, and a number of different products, has been very acquisitive. And then lastly, building materials, you've got vertically integrated operators, Granite and Glide companies, that are actively acquiring building materials and resource reserves. So lots of activity between just these logos here on the page. I would say overall the investor base that invests in this segment is quite large. As many of you know, this is a very large industry, and so it's going to attract a lot of interest from prospective private equity and strategic buyers. There's 4 that we wanted to. Yeah,
James,
go ahead.
Mike here. Just a quick question on that. You kind of touched on that. I forget which you mentioned as a segment that private equity typically doesn't play in. I mean, how do you think about that in terms of what's the difference between, you know, dealing with a private equity buyer versus a strategic buyer or seller for that matter? What sort of
it's a great question. It's a great question. So, you know, private equity buyers and strategic buyers have some material differences. Those differences are kind of merging together over time, but in general, a private equity firm is going to have much more limited experience directly operating in your industry than a strategic investor or buyer is. And so Peninsula Pacific in this example, or 10X or New Mountain, they might not have the operating experience that you have in your end market, but they might have an interest in your end market and an interest in backing really high quality management teams to take advantage of growth opportunities. Strategic investors and buyers are all, they have operating experience that is in your industry. Usually they bring resources to the table that are directly applicable to affecting day-to-day strategic responsibilities, and can offer companies distribution expansion, product or service line expansion, international expansion, branding benefits, ERP benefits. There's a number of things that strategic investors can bring to the table that private equity may not be able to. But again, those lines are more and more blurring as time goes on.
Great, thank you.
So four that are worth profiling here, just as examples. You have on the engineering side, Network Connex acquired Advantage Engineers. Advantage is out of Maryland, and Advantage is an ENR top 14 provider, about $40 million of revenue. They're focused on network engineering professional services on the front end of wired and wireless deployments. Network Connex had some involvement on the design side, and now they're able to fully integrate from a design and execution of the deployment work. Advantage would be keeping their two brands that they operate, and interestingly, Network Connex, back to your point there, Mike, is backed by Oryx Corporation, which is a private equity firm. And so acquiring Advantage Engineers was part of Oryx consolidation strategy in the telecom deployment service arena, using Network as Connex as the platform there. So interesting case study of a high-profile acquisition. Advantage Engineers had about 300 staff and PEs licensed in all 50 states, and so quite a good platform. Stowe, Structure Tone, on the construction side, recently acquired Abbott Construction. They also recently acquired Layton Construction, and as part of their attempt to build a national platform, construction services platform here, with exposure to all of the top MSAs in the country. Stowe has done, I believe, 4 acquisitions over the last 2 years. They were principally an East Coast firm, and now they've just really greatly expanded there. And it gives Abbott the opportunity to sell additional technical expertise here in the Pacific Northwest. That was an advantage that Abbott saw and an advantage that Stowe saw. Bain Capital acquired USLBM recently, and again, boy, just what a incredible consolidation happening on the building supply side right now. USLBM, Foundation Building Materials, Southern Carlson, HD Supply, really all performing aggressive acquisition strategies right now, and the multiples reflect that. If you're an independent operator in this space, the valuation multiples are pretty attractive there. And then lastly, another example of vertical integration, Clyde Companies and IHC Scott, which that transaction happened about 6-7 months ago. Clyde Companies is based out of Utah, and IHC is based out of Colorado. And Clyde Companies operates a network of materials resource reserves. IHC Scott is a major civil contractor, and so now IHC Scott can leverage Clyde's resource network. We see that type of acquisition happening in other markets as well. So interesting case studies here and examples of strategic buyers and private equity buyers. Private equity being Bain Capital on this page, and Oryx through Network Connex, and then strategic buyers being Clyde Companies and Stowe, for the kind of the rationales of why they're interested in these acquisitions in particular, but also how those acquisition strategies transcend to broader industry trends. So I promised that we'd talk about volume and valuations. And so these next 2 slides are focused on volume and valuations. On this, the E&C, and so engineering, construction, building products, middle market, M&A, volume activity, you can see on the left-hand side of the page here, you look at Q1 2020, that was a record high of 488 transactions in that quarter in this segment. And you see the steep drop off there into Q2 and then Q3 somewhat normalized. That's about 300 transactions in Q2 that are now pushed into 2021. And that is a significant amount of M&A volume. Those deals did not die. Many of them have come back. There was just uncertainty in how the markets would shake out in the middle of last year. And so again, uncertainty roils the M&A market. But you can see that the torrid pace of which M&A activity has come back in this segment, Q4 last year, Q1 and Q2 this year, all very near that record high of Q1 2020, the 488 deals. We think you will see 500 to 600 deals announced in Q3 this year and Q4 this year. Part of that being a makeup of those 300 deals that were pushed out from Q2 last year. And the remainder, again, just robust economic demand in fire and life safety and HVAC and cold storage and telecom, et cetera, et cetera. On the right-hand side of the page, building materials, building products, engineering, construction firms, a little bit of a mislabeling there. That bottom line is actually construction, and it usually is the lowest valuation of the four categories here. But you can see all four of those have rebounded quite significantly from their Q2 lows last year, quite significantly. Again, this goes to these buyers' willingness to pay for acquisitions. Their stock prices have increased significantly, so they have really good cash on the balance sheet, really good currency in their stock. And your Jacobs Engineerings of the world, Tetra Tech, et cetera, they have a willingness to pay for acquisitions right now. We expect this to continue into 2022. There are a few, the tax changes is one issue driving the market right now, but you also see quite significant demand in many segments. So we expect the M&A to continue at an elevated level, certainly through Q3 and Q4, but for the first half of 2022, we would expect it to continue.
James, you don't think there will be any kind of slowdown? It sounds like maybe even in Q1, just from any of the companies that were pushing to get deals done by the end of the year because of tax reasons. It sounds like you think there's enough demand to just keep it going quite steady throughout that whole period. Is that right?
Yeah, and Michael, you probably see this in your practice too, but in Q2 this year, when the threat of the cover page of the tax package came through, and it caused quite a shock. I mean, we were fielding multiple phone calls every day about companies wanting to sell their business by year end. And that was just a very common conversation thread. That conversation thread has certainly subdued, and folks have more of an interest from our perspective in selling because they just made it through a tremendously stressful time period. They recognize the need to succession plan. They're experiencing such robust demand that they feel like they could use the advantage of additional capital or additional resources from a strategic. We feel like those types of conversation topics are now dominating folks' interest in M&A. And so to your point, Mike, yes, there is a bump up because of tax planning for year end, but these other reasons for driving M&A activity that we've been hearing from our clients, we expect that's going to continue into Q1 and Q2 next year, and then perhaps level out to a more normal level.
So you're basically saying we shouldn't be planning any vacations between the two of us until at least late next year.
You got it, Michael. That's right on. It's a very busy time right now, but and like other industries in the M&A and transaction services industry, we're struggling to find labor people, just like construction is, just like engineering and building products is. There's just a number of markets right now are facing labor shortages, but that has not been getting in the way, though, of again trying to serve clients. This last page here, before I turn it over to Michael, Really important page here that we want to drive home: enterprise value to EBITDA valuation drivers benchmarking. We get asked to do this all the time. Companies that are interested in knowing what drives a higher enterprise value multiple versus a lower enterprise value multiple in my segment. And we put engineering, construction, and building products here just as two examples. But we have frameworks for many different segments. This is something that we do for clients in the interest of helping them plan for future exit opportunities or acquisition opportunities or where to deploy capital. You know, we try to, there's a range. I mean, not all acquisitions are created equal. You can see the same building products acquisition go for 18 times EBITDA or 5.5 times EBITDA. On the construction side, you know, for general contractors, you could see a 2 or 3 times EBITDA deal and a 5.5 to 6 or 7 times EBITDA deal. And there's just a variety of factors that cause that. And through our experience, we know that there are certain things that you can tweak and message and improve in order to improve that outcome. You know, just at a very exceptionally high level here for this call, you know, brand recognition, management team depth, you know, these are really important assets of a company. Customer concentration, you know, folks like a diverse customer base. You know, generally speaking, your largest customer isn't more than 10% of your revenue. Revenue visibility, we talked about certainty. The more certainty you can offer, the higher the valuation multiple. Geographic presence. Are you a one flag post location, or do you operate out of a super regional or national operations? Gross margin and asset utilization. You know, financial metrics do matter. They're kind of the output of everything up above that I had just mentioned, but they do matter. You know, going on to the building product side, you know, technical specifications of the product. How engineered is the product? Does it save labor? Does it allow somebody to do a project more efficiently and use less labor? Same customer concentration topics apply. Same management team depth applies. These are some of the things that we look at with companies that have an interest in benchmarking. Hey, here's where I'm at, and here's where I want to be over 3 years, 5 years, 1 year, 6 months. What tweaks or improvements, or where should we be focusing our energy on in order to maximize enterprise value and maximize the odds of a successful transaction outcome? These are things that we're happy to do. We enjoy doing it. And again, clients ask us to do this all the time well in advance of an actual transaction event. I'm going to turn it over to you, Michael, to talk about some of the deal issues that have come up that you've seen and what's kind of a hot topic in terms of diligence right now.
Sure. Thanks, James. And actually, just before letting you off the hook quite yet, I just had one last question, and it's actually something we come across quite often. You know, in a lower middle market type company, we found that, you know, where they have a number of contracts, and, you know, let's say their average contract size is 300 to 500,000 in revenue, something like that. But then every once in a while, they get sort of these blockbuster contracts that come in, you know, large multi-million-dollar contracts. How do you think about the multiple, you know, in a situation like that where there's sort of a stable base, but then there's also these blips, you know, that are intermittent between years? In terms of the multiple being on, you know, trailing 12 months, is it on 3 years? Is it on, how do you think about that?
Yeah, that's a great question, Michael. And one thing I failed to mention on this slide is these blue boxes are sliders. So, you know, not every building products company is 8 times EBITDA. I want to make sure that's clear that we slide those depending on the data that we see. But to your question, if you have large contracts that are lumpy, in your construction services firm, that is going to be a lower multiple. And in general, what investors and buyers do is they use a 3 or 4 year average of earnings over time to help kind of smooth that out. And we typically try to push the market to 2 years historical, 2 years forward. Some buyers will try to say, no, I'm just going to look at your 4-year historical average. And again, we try to push them forward too, because backlog really matters. At the same time, if those contracts are really high margin, you know, or when I say high margin, exceeding industry average margins, you know, that's a value enhancer. Overall, the more visibility you can offer to investors and buyers, the higher the valuation multiple. So a long-winded way of saying, Mike, those types of contracts are going to be really heavily due diligenced, and so being very prepared and thoughtful on a response, on how you want to respond to any of those issues that could come up, is really important.
Okay, great. Thank you. Great. So moving on to the diligence side of things, and I'll speak a little bit about transaction preparedness considerations. And as I mentioned, you know, we do financial due diligence at Moss Adams. And one area that has become really popular in the market is sell-side diligence. And so, you know, it's something that anybody who's getting ready to sell their company should consider. And, you know, if you would have looked at the market 5 years ago, it wouldn't have been as prevalent. Maybe 15 to 20% of transactions had sell-side diligence done on them. But more and more, if you looked at transactions now, if I had to estimate, I'd say it's maybe more like 80% of transactions are having a sell-side diligence exercise or report done on them. And the reason is that, you know, sell-side diligence can help organizations optimize the conditions of the sale, you know, maintain control of the sale process and help them avoid any loss of value. And we see, these are 6 key areas that, or benefits, I would say, that we see from doing sell-side diligence. First of all, you know, just allows the company to identify and address key risk areas or key issues or risk areas ahead of time. You know, and what you find is that if you don't do sell-side diligence, you know, statistically, based on our experience, over 50% of transactions end up being delayed due to accounting matters. So it just helps you be confident going into your position. And, you know, delays are bad during a transaction. In addition to that, it can not only help avoid delays, but it can actually accelerate the process by decreasing the amount of time that a buyer needs to understand your business, and it actually can increase the confidence. It can increase the confidence that a buyer has in your company and your preparedness, which also can help translate to better multiples and more negotiating power. Thirdly, you know, helps minimize surprises. If you are in diligence or under exclusivity and the buyer identifies certain issues and surprises come up, it can cause delays and loss of seller leverage. So many deals close at a lower purchase price than what was specified in the LOI because of this. And if it's an extreme surprise, you know, it could be a deal breaker, and that's just not good for anybody. So it can, you know, it can help you avoid deal breakers. You know, if a surprise causes a large enough gap between the buyer and seller expectations, that can happen, and it's a big waste of time, resources, and money when that happens. And then, more importantly, you know, often if a seller is not experienced with the M&A transactions, they might not know all the things that they have that they could be getting benefit for as they're going through the process of evaluation. And, you know, if a buyer comes in and does diligence, they're not going to tell you all the favorable things they find. They're just going to present to you any unfavorable items found. So it helps you get ahead of the game and claim hidden benefits in the valuation of your company. And then last of all, for any, you know, CFOs, controllers, VPs of finance out there in the audience, you know, it just helps you manage your resources. As anyone who's gone through a transaction knows, it takes a lot of time to manage a transaction and to do your daily job while you're in the midst of a transaction. And, you know, a lot of this preparation can help you avoid the stress at the time when you're under LOI and, you know, there's a tight time compression and you're under exclusivity. So it helps you get ahead of the game and manage your resources better. Just to touch a little bit, in terms of what we actually do in sell-side diligence then, at this stage, we try to take the view of the company from a buyer's perspective and prepare the seller. So, we can split it into several key areas, including financial due diligence and transaction tax. Those are the more common areas that someone would do seller diligence on. There are other areas you could do it as well that a buyer would be interested in. But, during financial due diligence on the seller side, we, first of all, help the management team in the company identify non-recurring items or gap deviations that, a buyer would be interested in knowing. We go through all the accounting policies and procedures historically, help explain all the complex transactions and critical estimates that are made in the company, and get this vetted out so that when a buyer comes in, that there's no questions about what's happened historically within the company. Sometimes some of these things, if there's been changes in policies, changes in accounting systems, it can be a real mess to actually sort through, and getting that explained ahead of time can really save a lot of time and headaches as you're going through your transaction. We'll also go through accounting software, financial closing processes, and an overview of analysis and controls. And these are things that potential strategic buyers particularly are interested in, and as well as private equity buyers who want to know that they're coming into a company that has solid systems. And if they don't, they want to be aware of it so that they anticipate any additional costs that might need to be incurred post-transaction. And most importantly, and often you'll hear sell-side diligence, you'll hear it referred to as a quality of earnings report that's done. And this refers to, helping the seller assess what the recurring earnings are of the business, and basically the earnings that a buyer will use to value the company. So, we'll take a deep dive on revenue and cost drivers within the business, identify key areas of risk such as customers, vendors, key employees, look at contracts, and we'll look at key contracts, particularly in the area of construction, and understanding the terms of these, the relative recurring nature of them, and how the accounting was done for those. And then last of all, we'll also help the company prepare for the transaction by assessing sort of what normal operating working capital needs have been. And as a lot of you probably know, a key term within purchase agreements has to do with delivering normal working capital, typically as part of the purchase agreement. And that can be a really contentious area, and we help you get ahead of the game and take a position on that in terms of how to define it and how to develop a methodology to develop targets. And then, other areas that I'd say that aren't necessary at the onset of doing the diligence, but as you're moving down the path of the transaction, you want to be thinking about transaction tax. In some cases, you could have exposures. Maybe you think you've fixed them, but there could be some exposures out there if you ever audited, that type of a thing. And buyers are always interested in getting those vetted out. And those can be time-consuming issues to deal with once you're, again, under LOI. If a buyer comes across these things, it may cause delays getting these things vetted and quantified. So you're much better off dealing with these up in advance on your own time and presenting them proactively as an issue to the buyer. And then last of all, the structuring of the transaction, depending on the structure of your ownership group, legal entity type, there may be certain things that you might want to pre-plan in terms of what you're willing to present to a buyer in terms of how you want the deal to be structured. And you can save a lot of money in post-transaction tax if you handle these areas properly. Oh, Amy, it looks like we have another polling question here. If you want to handle this.
All right, so our third polling question is, what is the likelihood that your organization will engage in a transaction over the next 24 months? A, highly likely, B, somewhat likely, C, unlikely, or D, will not happen. And I also want to take this time to remind our audience to submit your questions for the presenters using the Q&A window. And we will do our best to respond during the webcast, but if we cannot get to your question, we will follow up with you afterwards to get you the information that you need.
Hey, Michael,
like
there, on that prior slide, all of that can be done, a few months before closing of a transaction. But when I look at the slide, a lot of that can apply well before even starting down the process of a transaction. I mean, is that your experience as well?
It definitely. I mean, that would definitely be the best practice. I would completely agree. There's probably 60 to 75% of the work can be done well in advance of going to market. And, of course, people will want to have the current earnings of the company reflected in a package, but there's a lot of other things that can be handled prior to the time pressures that come under once you're going to market, definitely.
Yeah, and it helps you get out in front of any issues and just how you want to position them to the market too.
No, definitely. And, we've had situations where we've had major business decisions that were made after we went and did our sell-side diligence, where the owner of the company decided to make some major moves, like, shutting down an internal manufacturing operation and replacing it with an outsourced model for building materials in a certain segment within that business, because he didn't realize it was losing as much money as it was, because their accounting reporting wasn't really sufficient to highlight it. And, so the decision to go to market ends up being delayed, but down the road you end up optimizing the value of it. So it looks like our poll results are in. It looks like we've got some over 60% of the participants are highly or somewhat likely to be engaged in transaction over the next 24 months. So that seems to be pretty consistent with your expectations, James, on where the market is going. What I'll move into now is just, so that was a quick overview of sell-side diligence and why we do it. I just wanted to touch on what we're seeing in the market right now, particularly in the construction industry, engineering, of some of the key issues we're coming across. And some of these are always issues, and some of these are issues in the market right now. 4 key areas would be revenue and margin analysis. Secondly, COVID-19 impact on financial performance. Thirdly, supply chain disruptions, and fourth of all, just deal cycle changes. So I'll go into each of these a little bit more depth here. So, I'm just going to touch on some key areas that we see come up all the time for revenue and margin analysis. And this is a critical area for any buyer, whether it's a strategic or private equity buyer. They always want to have a really in-depth understanding of where the revenue is coming from, where the profit is coming from, the risk of certain customers, risk of certain contracts. So, one of the things that we always take a deep dive on, particularly for a company that has a lot of long-term contracts, is we assess the adequacy of their accounting. A lot of these shops will be using percentage of completion accounting, and as you know, there's a lot of estimates that go into this. And so we'll take a deep dive on their processes that they have in place for, estimating the expected costs and revenue of a contract, and how they manage that throughout the process until the closing of the contract. And more often than not, come up with, diligence adjustments around that to normalize those. So that's definitely a key area within the diligence of it. And within something more like building products, where building products manufacturer may be selling into the channel, into wholesale, or a variety of other customers, we often see interesting customer marketing programs that have been, executed Deductions from sales is always a contentious area that we dig into and need to get a better understanding of to make sure that they're being accounted for properly. And sometimes other programs like competitor acquisition costs, where they're buying space on the shelf at Home Depot, that type of thing, and understanding how those programs work and what's sort of the normal revenue and expenses around those things, as well as accuracy of costs. So aside from that, we want to understand the profitability, and often within the contracts of a company, whether it's engineering or construction, they're catering to a number of different industries, and getting a good cross-section or getting a good analysis of the business by industry is often very important to a buyer as well. So we try to take a look at that and understand how those trends have affected the performance of the company and the recurring nature of the earnings. And similarly, if it's more of a selling type of company, in building products, we often do deep analysis on sales by channel or by customer, by SKU even, and understanding how much profit is coming from new products, old products, etc., and taking a deep dive on supplier costs. And another area that we really want to understand, and James alluded to this, is understanding the company's current pipeline and backlog. And it's not necessarily something we can diligence, but we always want to understand that relative to the historical performance. So that's an area that we'll look into. And then lastly, a contentious area of diligence is often, warranties and returns, and making sure that in any industry, particularly that the gap accounting is correct for any potential liabilities for warranties and returns. And it's an area that, if a company isn't tracking this properly, can become a real issue in a deal if there isn't sufficient data to assess what the potential liability is of warranty liability, if a company has long-term warranty policies. So those are areas of revenue and margin analysis that we come across often. The next issue we're coming across, obviously, almost every transaction has a COVID-19 impact to it these days, and it can be a real struggle to determine what normal demand is. A lot of companies have had project delays and cancellations. Within certain businesses, we've seen a shift in demand between wholesale to e-com, and which can have impacts on profitability and the margin trends within a business. And then on the labor side, we've seen rate increases. We've seen all the government programs that affect the expenses being recorded by the company for labor. We've had furloughs. And then on the other expense side, a lot of companies have incurred costs for protective equipment and sanitation. And on the flip side, they've had travel expenses go down, marketing expenses go down, sometimes rent concessions. So there's been a huge number of issues driven by COVID that have affected, frankly, made it a lot more complicated to, for a company to, or for a buyer, I should say, to assess what's the normal, recurring revenue and profit stream for a company. And getting your position on these as a seller out of the way up front is really important, so that you're not at the whim of the buyer who's coming in and identify all these things. It's much better to be proactive about these things and address them, before you go to market, and understanding how a buyer is going to view them. And then, supply chain disruption, which is indirectly linked to COVID-19, but there are other factors, obviously, that have caused supply chain disruption. And, what we're seeing is that there's a lot of companies that have had non-recurring costs around inbound freight. They're, instead of bringing equipment or materials in by ocean, they're bringing them by air. A lot of companies have either had inventory shortages, or on the flip side, they've stocked up with their vendors to help mitigate any of the delays in the supply chain. a lot of companies have had shortages of equipment, and have had to, which has caused delays in their delivery of contracts. And then, all of these things have had an impact on the delivery and completion of projects for companies. So, particularly in this industry, it's really complicated to try to quantify these. But as a seller, you want to make sure that you're being reasonable, but don't miss out on potential opportunities to claim benefits around what you could provide analysis around to prove that these are non-recurring items. And then just last of all, and this is not just specific to an industry, but with how hot the market is, it seems to me, and I'm not sure if you have any opinions on this, James, but the deal cycle has accelerated. Once companies are under LOI, the process seems to have changed a little bit in terms of the timelines being given to buyers to get to close, and also more companies are being required to go down the path without having exclusivity to due diligence, and so it's causing a real compression in the market of professional advisor resources, frankly. So buyers are under more pressure to move fast. Resources are constrained in the market in terms of being able to handle the level of deal flow. So, as a potential buyer, particularly, and as a seller, you really have to have realistic timing expectations. If you're going to go to market, make sure you have your resources lined up and they can deliver on the timelines that you need to hit your goals. And if you're a buyer about to go in under LOI, you probably want to reach out to all your professional advisors too and make sure that they can meet the timelines that you're going to commit to, once under LOI. So, maybe one more polling question, it looks like.
All right, so our last polling question is, what top due diligence issue do you think may impact your transition? A, revenue and margin analysis. B, COVID-19 impact on financial performance. C, supply chain disruptions. D, lack of management succession plan. E, financial reporting. F, other, or G and A. And for those of you that would like a copy of today's slides, you can download them now from the folder that says slide deck and handouts, but we will also be sending them out via email tomorrow, along with a recording of this webcast.
And after this polling question, there's a few questions that came in, Amy, that maybe after this, Michael and I can address those.
All right, sounds good. All right, here are the results to the last question.
Yeah, so yeah, it looks like there's quite a few. Oh, there's quite a few NAs, but interesting. Yeah, so it's somewhat in line with what I would expect.
Yeah, and a lot of these are to distinguish, deal killers versus diligence issues. All of these, frankly, come up as diligence issues, and depending on the severity, can be deal killers. But as of certainly the last 9 to 12 months, supply chain disruptions, for example, is not going to be a deal killer. The market understands the issues that we're having from a supply chain perspective. One question that came in here that I wanted to address, how often do you, and Michael, you please provide your perspective here, how often do you see holdbacks on the purchase price to ensure projected revenue targets are met? There's a lot of creative strategies there. Some companies ask you to keep a portion of your equity, and we've seen an increase of that. And so 20 to 40% of the purchase price is you keeping your equity and having additional upside. frankly, that helps create a better, a more successful transaction outcome. Usually gets the sellers the liquidity they need, and also leaves added upside as part of a broader platform. That's not always the case. Sometimes folks use an earnout. I would say earnouts are still very common, but a smaller portion of the purchase price, usually it's about 20% of a purchase price, is going to be in the form of an earnout. It could be less than that, it could be 10%, if at all. In general, sellers would prefer to keep equity than have an earnout usually, but sometimes personal circumstances would indicate, you don't want to be an owner, and you're fine. You'd rather have the cash payment on an earnout. Lots to discuss there, though, but that's what we've been seeing. I don't know if you'd add anything there, Michael.
Yeah, James. Yeah, I would. I would say that I think from my standpoint, we've seen an increase in the use of earnouts this year, particularly in situations where buyer and seller just can't quite bridge the gap between what is what is a permanent change in a business model and what's a temporary change due to COVID. And I think depending on the industry and the situation, we're seeing earnouts being used to help bridge that gap.
Couple questions here came in on what comprises working capital, and then RevRec ASC 606. Michael, do you want to take a first cut at those?
Sure. We could start with working capital. Specialty trade contractor. Elements typically comprise working capital for the sale of a specialty trade contractor. So you're going to have, if you think about your balance sheet, you've got your current assets, current liabilities, of course your receivables, if you have any inventory, there could be, any of your unearned revenue likely would be, because it's incurred in the course of regular operations, would be included in working capital. I'm not sure if there's any specific. It's more a case of what might be excluded. James, do you have any thoughts on that in terms of other items? Yeah,
payables obviously, and then over under billings, if applicable. Mm-hmm. That's not applicable to many, right. Perhaps many on the call here, but it's really going to be case by case, because mm-hmm. you look at construction, especially contractors, engineering firms, building products, building materials. There's really, everybody's balance sheet there looks different. For a traditional mm-hmm. specialty trade contractor, I think exactly what Michael said there.
Yeah, and I would say, that is, every balance sheet is a little bit different, and that is something where we literally, when we're doing our diligence, go through line by line and understand the nature of each item, and also look at things that may have been non-recurring as well. So it's a fairly complicated, or I shouldn't say complicated, but in-depth exercise. In terms of ASC 606, we address it in our transactions, but quite honestly, I don't think revenue recognition has become revenue and cost recognition. I don't think it's become any more of an issue than it ever was. ASC 606 has certainly caused some changes in the way certain companies are reporting, but I don't think it's become a much more significant issue. I think it just has caused a little bit more explanation during our diligence process in terms of any changes of accounting policies that companies have had. But I don't think it's really necessarily changing the way that buyers value a business.
Yeah, and completely agree, Michael. And then just a shout out to the Moss Adams TS Transaction Services team. They did find one of our clients was way overly conservative on revenue recognition, and they found a $500,000 EBITDA, positive EBITDA adjustment. And that's very, very meaningful when you multiply that by 6, 7, 8 times. You're talking about a $4 million benefit just from that find.
Yeah, and honestly, that's pretty common in this industry, right? With percentage of completion accounting, there's a lot of controllers or CFOs out there who don't want to have surprises month to month when they're reporting the results, but they're overly conservative in terms of estimating how far through contracts are, and that can cause a lot of timing differences on revenue and margin recognition that are important to go through.
I think we've hit the hour here, Amy.
All right.
Appreciate everybody.
Yes, we have.
I was just going to say, I appreciate everybody's time and listening in today. Hope you found it beneficial, and it sounds like the slides are available, correct, Amy?
They are, yes. And we will be sending them out tomorrow as well. And thank you, Michael and James, for a really interesting presentation today. And to our attendees, if you met all CPE requirements, your certificate is available to download now in the CPE progress window. I'll keep the console open for a few minutes to give you time to download. Otherwise, we will be sending out an emailed version within a few weeks if you have difficulty downloading it now. And then also a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in your console. And finally, here's a link to an online survey for today's presentation. Please take a moment to complete the survey, as your feedback is very important to us. And thank you for joining our webcast. And thank you, Michael and James, and we hope you'll join us again next time.
Thanks, Michael. Thanks, everybody.
Thank you.